Ever wondered what actually makes a business tick, beneath the surface? From that corner coffee shop to a global corporation, there's this whole world of legal structures and financial ground rules. They dictate how businesses operate, how they're taxed, and, well, even who's responsible when things go sideways. It's definitely a complex landscape, but it's absolutely essential to navigate, especially for any entrepreneur, anyone thinking of starting a business, or honestly, just the intensely curious among you.
Precisely. And today we're taking a deep dive into these foundational elements. We're talking business entities and their financial reporting. We've pulled together a pretty comprehensive stack of sources, everything from the simplest sole proprietorships right up to some intricate accounting rules. Our mission really is to demystify these core concepts. We want to help you understand the critical distinctions and why they truly matter for anyone involved in commerce.
Yeah, and by the end of this deep dive, you should have a much clearer picture. Different business types, how their profits get taxed, those crucial reporting obligations, and the accounting principles that really underpin financial health. Hopefully you'll gain those aha moments that connect a business's legal form directly to its daily operations and, well, its long-term strategy. So let's unpack this. Okay, let's kick things off with maybe the most common business type in the U.S. Makes up something like 70% of all businesses, the sole proprietorship. What makes this structure so appealing to so many people?
Well, the primary draw is its sheer simplicity. I mean, really, it's not a separate legal entity from its owner. Essentially, you are the business, even if you hire employees. This means there's no state-level formation needed, typically. You can generally start operating with just your Social Security number.
So minimal bureaucracy then. That sounds pretty good. And how does that simplicity translate to their tax identity?
Tax-wise, it's very straightforward. Your business income and expenses, they get reported directly on your personal Form 1040, usually via Schedule C or Schedule F if you're running a farm. Income is just taxed at your personal rates. And business losses can even offset other personal income you might have. But here's something crucial, a strategic insight maybe. Because you are the business. You can't sell the sole proprietorship entity itself. You're selling the assets and the new owner. They have to establish their own entity. That can create complexities if your long-term vision includes selling the whole business as a going concern.
Okay, that's a really key point about selling. Now, moving from just one person, when two or more people decide to join forces, we often think of a partnership. But it's rarely just a handshake deal, is it?
That's right. For federal tax purposes, a partnership is generally an unincorporated organization where the members divide up the profits. These can range, from a small two-person operation to literally thousands of partners. A core feature of partnerships is what's called pass-through taxation. The business itself files an information return that's Form 1065, but it doesn't pay income tax itself. Instead, the profits and losses are, well, they're passed directly through to the partners, and they get taxed just once on their individual returns. That happens via Schedule K-1.
Okay, so partners aren't employees. They don't get W-2s. But that K-1 clearly outlines their share of the income or loss. Makes sense. And when it comes to liability, there has to be at least one general partner, right? Someone who's personally on the hook for the business's debts.
Correct. That personal liability for general partners is a significant consideration, absolutely. But what if the arrangement is less formal? Say, co-owners just sharing expenses for a rental property. Well, that's not always a formal partnership unless they're providing substantial services. Think like daily cleaning or maid service you'd find in a hotel or B&B. Otherwise, it's often just reported on Schedule E as passive rental income, not really as a partnership on Schedule C. The key is understanding if both partners are actively and regularly involved in the business operations, what the IRS calls materially participating.
That distinction for co-ownership is really important.
Got it. Now, beyond the general partnership, we start seeing some variations that offer limited liability, which frankly, it sounds much more attractive. What about a limited partnership, an LP? Right, an LP introduces this concept of a limited partner. They're essentially an investor, someone who owns an interest but doesn't assume personal liability beyond their initial investment. They are truly only investors, typically. They don't usually have a managerial role. And their income from the LP, it's considered passive, so it's not subject to self-employment tax. The structure is more formal, though. It requires state-level filing, like California's Form LP1.
And for professionals, like lawyers or accountants, there's a specialized form, the Limited Liability Partnership or LLP. What makes that particular structure stand out?
An LLP is it's a fascinating structure. It's often used in professional services, where LLCs might actually be prohibited in certain states. Think California or New York for law firms, for example. The
Ooh.
critical advantage here is that LLPs allow partners to be active in management and have limited liability protection. It usually shields them from liability for their partner's malpractice or the general business debts. Though they're still responsible for their own actions, of course, it provides this unique safeguard for individual professionals within a partnership setting.
Okay, so different flavors of partnership. Now, when we think of big business, corporations usually come to mind first. What really defines a C corporation, the sort of standard corporate structure?
Well, a C corporation is a distinct legal entity, completely separate from its shareholders. It conducts business, it realizes income, it distributes profits independently. Most major companies you interact with daily, they're C corporations. But here's a critical point, and often a major concern for business owners considering this structure. It's the double taxation aspect. The corporation pays tax on its income, currently a flat 21%, thanks to the Tax Cuts and Jobs Act. And then the shareholders. They get taxed again when they receive dividends from those profits. Plus, losses generally can't be deducted by the shareholders personally.
Oof, double taxation. That definitely sounds like a significant drawback. Are there alternative corporate structures, ways designed to maybe mitigate that particular issue?
Absolutely. And that's where the S corporation comes into play. While it's still a legal corporation, it makes an election with the IRS. It elects to be taxed as a pass-through entity, quite similar to a partnership, actually. This means income, losses, deductions, they all pass directly to the shareholders, and they're taxed only once at the individual level. There are some limitations, though. Generally, you're capped at a maximum of 100 shareholders, and you have to file Form 2553 to make that S election, and you have to adhere to some pretty strict timing rules.
Right, the S Corp election. Heard that can be tricky. And then there's the limited liability company, the LLC, which seems to offer this kind of flexible hybrid approach.
It's a great blend, really. An LLC is formed at the state level, but its federal tax treatment is incredibly flexible. If it has just one owner, it can be a disregarded entity, basically taxed like a sole proprietorship. It can also elect to be taxed as a corporation, either C or S, or, and this is most common if it has multiple owners, it can be taxed as a partnership, filing that Form NUNA 65. There are also professional service LLCs or PLLCs for licensed professionals in some states, similar in function to the LLPs we mentioned.
Okay, that flexibility is really interesting, especially maybe for married couples running a business together. What's a qualified joint venture or QJV, and how can that simplify things for them?
Right, so if spouses run a small business together, but they haven't formed a formal state law entity like an LLC or corporation, they'd usually just be treated as a partnership by default. However, if both spouses are actively and regularly involved, that material participation standard again, and they are the only members, they can elect QJV status. This lets them file separate Schedules C and SE on their joint tax return. And that's crucial for getting individual Social Security credits later in life. So, for married couples, this can significantly simplify their tax filing compared to a full partnership return. There is a narrow exception, though, for community property states like California or Texas. There, they can sometimes form a multi-member LLC and still elect to file as a QJV. It's a specific nuance.
Okay, so lots of choices on structure. Now, just like individuals have Social Security numbers, businesses often need an EIN. When is an employer ID number, an EIN, absolutely essential?
An EIN is basically your business's federal identification number, mostly for reporting purposes. Essentially, if you're operating as a formal legal entity, think corporation or partnership, you need one. Or, critically, if you plan to hire employees, an EIN is mandatory. A sole proprietor with absolutely no employees usually doesn't need one, technically, though many choose to get one anyway, maybe for privacy, to protect their SSN from entities issuing them on 1099 NECs. But for any employer or most formal entities, yeah, an EIN is non-negotiable. You'll need one for each separate entity you form too.
Got it. Now, one of the biggest headaches and honestly the potential liability risk for businesses is getting worker classification wrong. What's the core distinction? Employee versus independent contractor.
Yeah, this is huge. The accurate determination is critical. Why? Because businesses generally are not required to withhold or pay employment taxes for independent contractors, but they absolutely are for employees. It involves looking at the degree of control the business has, behavioral control, financial control, and the overall nature of the relationship. Misclassifying an employee as an independent contractor, that can lead to significant penalties, back taxes, interest. It's messy. So a clear understanding of each worker's role is just paramount.
Right, you definitely don't want to mess that up.
Yeah,
So
no.
most workers fit neatly into those two boxes, employee or contractor. But then there are these unique cases the IRS calls statutory workers. Who falls under statutory employees?
Statutory employees are interesting. They actually receive W-2s from their employers, just like regular employees. But they report their income and related expenses on Schedule C, much like self-employed individuals. The key difference, though, is they don't pay self-employment tax. That's because their employers treat them as employees for Social Security and Medicare tax purposes, FICA taxes. Think of full-time life insurance salespeople, certain commissioned truck drivers, or traveling salespeople who meet specific criteria set by the IRS. You'll see Box 13 checked on their W-2 form. That's the giveaway.
Okay, and what about statutory non-employees? That sounds like a bit of a double negative.
Small chuckle. It can be confusing. There are three main categories here: direct sellers, licensed real estate agents, and certain companion sitters. They are treated as self-employed for all federal tax purposes if their payments are based on sales or output, not hours worked. And they have a written contract stating they aren't employees for tax purposes. Their compensation gets reported on Form 1099 NEC, and then they, in turn, report it on their Schedule C. The IRS basically provides these specific categories to simplify classification for these fairly common work arrangements.
Makes sense. Okay, let's talk about bringing family into the business. Seems common. Are there special tax rules if you employ, say, your child or your spouse?
Yes, absolutely. And this can present a great planning opportunity for some families. If your child works for your sole proprietorship or for a partnership where both parents are the only partners, their wages are subject to income tax withholding, just like any employee. However, and this is the key part, if the child is under 18, their wages are not subject to Social Security and Medicare taxes, FICA taxes. And if they're under 21, those payments are also exempt from federal unemployment tax, or FUTA. This special rule, really designed to save on payroll taxes and maybe shift some income, does not apply if the business is a corporation. That's important. Now, for a spouse working for a sole proprietorship, their wages are subject to income tax, Social Security, and Medicare taxes, but they are not subject to FUTA tax. However, if that spouse works for a corporation or a partnership where the other spouse is also a partner, then FUTA would apply. These nuances really highlight how your chosen business structure dictates these detailed employment tax rules.
Wow, okay, so the structure really matters there. You just mentioned FUTA tax. Can you give us a quick overview of what that is?
Sure. FUTA stands for the Federal Unemployment Tax Act. It helps fund state unemployment compensation systems. It's paid only by the employer, never the employee. That's key. The rate is technically 6% on the first $7,000 of each employee's wages for the year. But most employers receive a maximum credit of 5.4% for the state unemployment taxes they pay. So that effectively reduces the federal rate down to 0.6% for most. And once an employee earns $7,000 in gross wages in a year, the FUTA obligation for that specific employee stops for the rest of the year. It's reported annually by the employer on Form 940.
Okay, unemployment insurance funding. Got it. Now let's discuss something that can be, well, incredibly serious for business owners. The trust fund recovery penalty. What exactly is this, and why should every business owner be acutely aware of its implications?
This is really serious stuff. It's often called the 100% penalty because it equals the full unpaid balance of what are called trust fund taxes. What are those? They're funds like income tax and the employee's share of Social Security and Medicare taxes that an employer withholds from employee paychecks. They're called trust fund taxes because the employer is essentially holding these funds in trust for the government. They don't belong to the business. Now, if any person who is responsible for collecting or paying these taxes willfully fails to do so, the IRS can assess this penalty against them personally. That means they can go after your personal assets, house, bank accounts, whatever. And it's not just the CEO or owner. It could be anyone with the authority to sign checks, decide how funds are spent, maybe even a bookkeeper. This penalty really highlights the severe personal responsibility involved in managing payroll taxes correctly. Don't mess with payroll taxes.
Wow. Yeah, willfully fails sounds ominous. Personal liability is huge there. Okay, so beyond the main entity tax returns, what are the big forms businesses use to report payments they make to others, like contractors?
Right, reporting is key. For employees, you'll issue Form W-2 by January 31st each year. That reports their wages and all the taxes withheld. For independent contractors, you'll generally issue Form 1099 NAC. That's for non-employee compensation. You issue that also by January 31st for any payments of $600 or more made during the year for services.
Okay, W-2 for employees, 1099 NEC for contractors. I often get Form 1099 MISC confused with the NEC, though. What's the difference there?
That's a common confusion, especially since the NEC form was broken out separately a few years ago. The 1099 MISC for miscellaneous information now covers other types of payments of $600 or more. Think things like rents paid for office space, prizes and awards, certain medical and healthcare payments, also royalties of $10 or more, and gross proceeds paid to an attorney, $600 or more threshold there. A crucial point to remember for both 1099s is that, generally, payments made to corporations, both S and C, are exempt from 1099 reporting, and purely personal payments, like paying your neighbor's kid to mow your lawn, are also not reportable on these business forms. These forms cover payments made by cash, check, or ACH transfers.
Okay, that clarifies MISC versus NEC. What about payments made via credit card or online platforms? Like if I pay a contractor through PayPal or for a rideshare driver, how are those handled?
That's a great question, and it's different. Those fall under different rules. Credit card transactions and payments made through third-party settlement organizations, think PayPal, Stripe, Square, Venmo for Business, are reported by the payment settlement entity itself. They report these on Form 1099-K. For 2024, the reporting threshold for these 1099-Ks is set at $5,000 in gross earnings from goods and services. That threshold has been changing, so keep an eye on it. So, your Uber or Lyft driver, they'd likely receive a 1099-K from Uber or Lyft, not a 1099-NC from you, the rider.
Right, 1099-K for those platform payments. Makes sense. Finally, on reporting, let's talk about large cash payments. Is there a special form businesses need to worry about for those?
Absolutely. This is about Form 8300. If a business receives a cash payment of more than $10,000 in a single transaction or in related transactions, it must file Form 8300, Report of Cash Payments, over $10,000 received in a trade or business, and they have to file it within 15 days of receiving the cash. Plus, you also have to provide a written statement to the customer involved by January 31st of the following year. Now, it's really important to know how cash is defined here. It includes actual currency, yes, but also cashier's checks, bank drafts, traveler's checks, and money orders under certain conditions. But it specifically excludes wire transfers, credit cards, ACH payments, or personal checks. This form is a critical tool for the government in combating money laundering activities.
Okay, clearly, proper reporting and classification are absolutely non-negotiable. Huge responsibilities there. But how do businesses actually track all this financial activity? Let's shift gears a bit. What are the underlying systems and decisions that dictate how money flows in and out and how it's ultimately recorded for tax purposes?
Right, that leads us directly into accounting periods and accounting methods, essential stuff. While individuals almost always use a calendar year, January 1st to December 31st, businesses have more flexibility. You can adopt a calendar year too, sure. Or you can choose a fiscal year. A fiscal year is basically any period of 12 consecutive months ending on the last day of any month except December. So ending June 30th or September 30th, for example. Some businesses, particularly seasonal ones, think maybe a ski resort or that fireworks vendor example, might even opt for what's called a 5-to 53-week fiscal year. That always ends on the same day of the week, like the last Friday in July. It helps align reporting with their natural business cycle. A business generally adopts its tax year when it files its very first tax return.
Okay, so some flexibility.
Mm-hmm.
But does every business get to choose any fiscal year they want?
Yeah.
Seems like that could be used to delay paying taxes.
Not always, no. The IRS thinks about that too. New C corporations generally have the most flexibility in choosing their year end. However, partnerships and S corporations, they usually have required tax years. These generally must conform to the tax years of their owners, the partners or shareholders. The IRS wants to prevent artificial deferral of income. So to use a different year, they usually need to establish a bona fide business purpose. You typically file Form 1128 to request that. For example, a partnership where the majority owner already runs another business with a December 31st year end. That partnership would likely have to follow suit.
Right, the required tax year rules. But is there a way for some partnerships or S-Corp to choose a non-required tax year without having to prove that business purpose?
Yes, there is an exception. It's through something called a Section 444 election. You file Form 8716 to make this election. This allows certain partnerships, S-Corp, and personal service corporations to choose a tax year different from their required year, but only within limits. It usually allows for only up to a 3-month deferral period. It's essentially an election to create a limited deferral period for income recognition, not available if you already qualify for a different year based on a business purpose. And there are specific requirements, like the entity can't be part of a tiered structure. It also involves making certain required payments to offset the deferral benefit.
Okay, Section 444 election. Good to know. Now let's talk about how income and expenses are actually recorded day to day. What are the two main accounting methods businesses use?
There are two primary accounting methods. cash, and accrual. Under the cash method, you generally deduct expenses when you actually pay them, and you record income when you actually receive it. Cash in, cash out. It's the most common method for small businesses, mainly because it's simpler to track. The accrual method, on the other hand, is used by most large corporations, think Coke or Nike, and it's actually required for publicly traded companies. With accrual, you recognize expenses when they are incurred, regardless of when you pay them. And you recognize income when it is earned, regardless of when you actually receive the cash. This method generally provides a more accurate picture of a business's financial health and taxable income over time, matching revenues with the expenses incurred to earn them.
Okay, cash versus accrual. More accurate matching with accrual, but simpler with cash. And there's a specific threshold, right, for who can use the simpler cash method.
Indeed, there is. Under the Tax Cuts and Jobs Act, most businesses, the main exception being tax shelters, can use the cash method if they meet the annual gross receipts test. For 2024, that threshold is $30 million in average annual gross receipts. That average is based on the 3 preceding tax years. So it allows many fairly large businesses to still use the cash method if they choose. It's also worth noting if you happen to operate 2 separate and distinct businesses, say a retail store and a consulting practice, you can potentially use different accounting methods for each one, as long as you maintain completely separate books and records for each distinct business.
30 million, that's a pretty high threshold now. Good to know. What if a business wants to switch accounting methods? Maybe they started small on cash basis, grew, and now accrual makes more sense. Is that just a simple decision they make?
Not usually, no. While you choose your first accounting method when you file your very first tax return, subsequent changes generally require IRS approval. You typically request this approval by filing Form 314M, Application for Change in Accounting Method. This isn't just for changing your overall method from cash to accrual or vice versa. It also applies to changing how you value inventory or changing your method of accounting for depreciation, among other things.
Form 31440 for changes. Okay.
Oh.
What if a business, say, just missed taking depreciation expense on an asset for several years? Can they go back and fix that easily?
Oh, that's a really common scenario, actually, forgotten depreciation. If it was only missed for one prior year and that year is still open to amendment, you might be able to just amend that prior year's return. But if it's for multiple years or a closed year, then you absolutely need to file Form 3115 to correct it. It's considered a change in accounting method. But here's the key insight, and it's often good news. Unclaimed depreciation, even from years that are technically closed, can often be caught up and allowed through what's called a Section 481A adjustment. This adjustment usually reduces your taxable income in the year you file the Form 3115, effectively letting you claim that missed depreciation now. If the total adjustment is favorable and less than $25,000, you can typically take 100% of it in the year of the change. Larger adjustments might be spread over several years. And just a quick reminder on depreciation, you never depreciate land. Land isn't considered to wear out like buildings or equipment.
Right. Never depreciate land. Good reminder. Okay, let's look into inventory. For businesses that actually sell products, cost of goods sold, or COGS, is a truly critical number on the income statement. What exactly does COGS represent?
COGS is fundamental for any business selling goods. It represents the direct costs attributable to producing or purchasing the goods or services that you've actually sold during a period. It's deducted directly from your gross receipts, your total sales, to determine your gross profit. That's a key measure of profitability. Think of the basic formula: beginning inventory value plus inventory purchases and production costs during the year-ending inventory value. Cost of goods sold. Included expenses typically cover things like raw materials, freight in, cost to get materials to you, storage, direct labor involved in production, and factory overhead. It's all about understanding the true cost associated with the specific items you sold, not just the overall cost of everything you bought or made.
Okay, so it's not just the purchase price of what you bought. It's tied to what's been sold. Can inventory even be intangible? You mentioned a movie studio earlier, for example.
Exactly. Inventory isn't always something you can physically touch. For a movie studio, the costs of producing a film actor's salaries, set construction, filming costs are all capitalized into an inventory account. That cost stays there until the movie is released and starts generating revenue, essentially, until it's sold to audiences via distribution. At that point, those capitalized costs are expensed through COGS, matched against the revenue the film brings in. It truly reflects the cost of what you've sold, whether it's a physical product off a shelf or an intangible creation like a film or software.
Fascinating. So film costs are inventory. And then we encounter the Uniform Capitalization Rules, or UNICAP. These sound pretty technical, maybe even intimidating.
They can be, admittedly. But at their core, the UNICAP rules provide detailed guidance on which direct costs and also certain indirect costs related to producing goods or purchasing merchandise for resale must be capitalized as part of the inventory's cost, rather than being immediately expensed in the year incurred. Think of it like this. If you're building a house to sell, UNICAP basically says you need to include all the relevant costs in the total cost basis of that house. Not just the lumber and bricks, but also things like a portion of a construction supervisor's salary, depreciation on the construction equipment used, maybe even some administrative overhead related to the project. These costs get added to the inventory value and are only recovered through cognizance when the house is finally sold. It applies broadly to producers of tangible and intangible personal property, real property, and also businesses that acquire wholesale inventory for resale.
That analogy helps clarify it, capitalizing more costs into the asset. But do all businesses that have inventory have to follow these complex UNICAP rules?
No, thankfully. And this is a really key takeaway, especially for many small to mid-sized businesses listening. The Tax Cuts and Jobs Act significantly modified these rules. Now, businesses that do not exceed that same $30 million average annual gross receipts test we mentioned earlier, averaged over the prior 3 years, are generally not required to apply the UNICAP rules. This exemption simplifies inventory accounting dramatically for a huge number of companies.
Okay, another benefit of that $30 million threshold. That's great news for smaller businesses. So for those larger businesses that are subject to UNICAP, what types of costs typically get included, capitalized into inventory?
It's pretty broad for producers and resellers subject to the rules. It includes the obvious things like merchandise purchased for resale, raw materials, work in process, and finished goods, but also supplies that will become part of the item for sale, like labels or packaging materials. It even includes purchased merchandise where the title has passed to you, but maybe it's still in transit on a truck or ship at year end. And as we discussed, intangible costs like film or software production costs can also be subject to UNICAP. Conversely, things that are never included in inventory under UNICAP are assets like land, buildings, or depreciable equipment used in the business. Those are capitalized and depreciated separately. Also, goods you've already sold or goods held on consignment to your business where you don't own them are excluded. Importantly, regardless of business size, pure marketing and advertising costs, research and experimental expenditures, which have their own specific tax treatment, and certain qualified creative expenses for self-employed writers, artists, etc., are typically exempt from UNICAP capitalization.
Got it. Lots of specifics there. Finally, let's talk about inventory shrinkage. It happens. What happens from an accounting perspective when inventory simply disappears? Gets lost, stolen, damaged?
Right. Inventory shrinkage is just that general term for inventory that's gone for reasons other than being sold, lost, stolen, damaged, obsolete. When this happens, it effectively reduces your ending inventory count and value. And remember our COGS formula. Beginning inventory plus purchases ending inventory equal COGS. So, if your ending inventory is lower due to shrinkage, that mathematically increases your cost of goods sold for the period. You generally have two main ways to record the loss in your books and tax return. You can either let it automatically increase your COGS when you do your year-end inventory count, or you can specifically track and record it separately as a casualty or theft loss expense line item. The key really is consistency and ensuring you don't effectively count the loss twice, once in COGS and again as a separate loss. Also, a crucial point, if you expect an insurance reimbursement for the lost or damaged inventory, you generally shouldn't claim a tax loss to the extent you expect to be reimbursed. Wow, we have certainly covered a tremendous amount of ground in this deep dive. Everything from those foundational choices of business entities to sole proprietorships, partnerships, C-Corp, S-Corp, LLCs, all the way through the nuances of employment taxes, critical reporting requirements like those Forms 1099 and 8300, and then to the essential accounting principles like tax years, cash versus accrual methods, and the sometimes complex world of inventory accounting with COGS and UNICAP.
Yeah, absolutely. And what we really hope you take away from all this is that every single business, truly, regardless of its size, operates within this critical framework of legal and financial rules. Understanding these rules isn't just about, checking boxes for compliance. It's really about making informed, strategic decisions. Decisions that protect you legally and financially, that help optimize your tax situation, and ultimately that define your business's trajectory for success. These aren't just dry, boring rules. They are fundamentally the underlying mechanics of how the entire business world functions, and knowing them helps you thrive within that world.
It really does, and it kind of highlights an important question to ponder, doesn't it? Given this really intricate dance between your business structure, all the tax implications, and your financial reporting choices, How might a seemingly small decision you make about your entity choice today, how could that ripple through literally every aspect of your business's growth, its operational efficiency, and its overall financial health, years, even decades down the line? It's really a testament, I think, to the power of understanding these fundamentals right from the start.
That's a great thought to leave with, the long-term impact of those early choices. Keep exploring these ideas, keep questioning, and thanks so much for taking this deep dive with us today.